Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for the segment, we have Steven Ehrlich, director of research with digital assets over at Forbes Crypto, for our monthly review of what's going on in this space. And Steven, it's great to see you as always. Welcome back to Trade Talks.
Yeah, same, Jill. Thanks for having me.
And just like with everything else with the global markets, we want to know about the uncertainty over Ukraine and how that's impacting global markets and by extension, crypto.
Yeah, exactly. It's on a lot of people's minds right now. Crypto certainly is not immune, and it's probably being hurt a little bit more than some of the more traditional markets right now because of its higher volatility, its higher beta as a result of the Russian invasion into Ukraine. Most major assets are down more than 10% over the last 5 days. Bitcoin itself is down about 7% or so, and a lot of these bigger assets are falling below the 200-day moving average, which is kind of an important longer-term trend. One chart that a lot of people are looking at very closely, myself included right now, is the difference between gold and Bitcoin, because Bitcoin sometimes is promoted as a digital version of gold. And right now, gold is up about 0.4% over the last 7 days, whereas Bitcoin's down over 7%. So we're seeing a big divergence here. That said, it is worth noting that some of the cryptos have started to recover and pare back some of those losses in the last day or so. Most of them are up about 1% or so far, or 1% or so over the last 24 hours, and we'll see what happens. But that said, I expect longer term to be on this tenuous ground for some time as people move into gold and other types of commodities, and we really try to figure out like what is going to be the longer term economic impact of this crisis. Sanctions that are being discussed at this point, I know Germany shut down or at least revoked its approval of the Nord Stream pipeline between them and Russia, but most of the sanctions right now are trying to be geared towards oligarchs and really trying to be surgical so that they don't hurt the economy, inflation, and ordinary people. But at some point that may change, and that could lead to a deeper economic type of recession.
Yeah, well, it's really interesting because it's not only oil and natural gas that we have to worry about, but many of the commodities and components that go into the semiconductors that really are driving the technology that we use today. And I think that's even an underlying bigger issue that we need to focus on. And I think another issue is, Stephen, of course, is will this have an impact on proposed central bank tightening plans around the world? I don't think this was something that central bank presidents and so forth were thinking of 6 months to 12 months ago as they were looking to revamp their policy. I mean, this really is a big cog in the mix here.
It definitely is. I mean, ever since the first conflict in Ukraine ended back in 2014, everyone knew that this issue could crop up again. But this was not something that people were really worried about in January, and especially late last year when inflation really started to climb in the U.S. and around the rest of the world. And now a lot of people are wondering what's going to happen at the Fed. I still expect them to raise the rates as they said they're going to in March. Probably no more than 25 or 50 basis points. And as some people were projecting more than that, I don't see that being the case. Europe, I'm not quite sure what's going to happen there, because that economy is probably going to be impacted worse due to economic sanctions than the U.S. is, at least for the time being. But at the same point, if oil prices go up because it is a global fungible market, that's going to reverberate around the world when it comes to inflation. And the Fed and its central bank brethren around the world are going to have to figure out how to weigh all these different competing priorities so that they don't let certain aspects of the economy, of certain segments of their economies, overheat and try to find a way to kind of mangle through all this. So it's going to be really tricky to watch. And from a crypto price perspective, on the one hand, you have a risk-off climate, which typically has not been good for crypto. But at the same time, if it leads the Fed and other central banks to sort of slow down their tightening schemes, that could act as a dampener to some effect. So it's going to be interesting to watch.
And for sure, you know, what else is interesting, Stephen? It seems as if NFTs have largely been immune to some of the volatility that we've seen in the digital asset space, but it doesn't mean that they're immune completely from some type of issue. There was a major exploit among NFTs at OpenSea. So explain to us what happened there.
Right. So OpenSea is the biggest NFT marketplace in the world by a large margin. They just closed a round of funding that valued the giant at $13.3 billion, which is a staggering sum of money. And right now, a lot of these platforms, I mean, they look sleek and they are well built, but there's always going to be bugs. There's always going to be glitches. And OpenSea's actually had a couple of issues in the last few weeks or so. Back in late January, there was a glitch on its listing interface where some people unwittingly sold very valuable NFTs at a fraction of their worth, of their price, and it led to investors losing about $1.8 billion worth of inventory that OpenSea has I believe compensated them for, but at the same time, I believe one of those affected individuals actually just launched $1 million lawsuit against OpenSea. So we'll see what happens there. But more recently, over the weekend, I think it happened either Friday or Saturday night, and it sent crypto Twitter ablaze. There was a fear that OpenSea itself was being hacked. It happened when OpenSea was updating some of its smart contracts. For people who don't know, smart contracts are essentially the programs that help platforms like OpenSea interact with blockchains where all this happens. And it looks like a sophisticated attacker phished or basically fooled about a dozen and a half holders of very valuable NFTs to actually sign them over to this hacker, which then they were able to sell for a profit. It's no different than being tricked and handing over your email credentials to somebody else, but this time it happened with NFTs. And there was a lot of confusion, a lot of fear that if OpenSea itself got hacked, that could have been almost like a market nuking type of event. But even still, it's very much a cautionary tale. And NFT theft is not something that has gotten a lot of attention so far. It's really been more DeFi and exchanges. But as NFTs grow and as more people get access to them, I would expect NFT related crime to go up quite significantly. So it's very important for anybody, no matter what you're doing online, banking, social media, or collecting NFTs, to be very careful about what links you click on and what types of programs you interact with, because sometimes you're not going to be able to be made whole again.
Yeah, and this is why we can't have nice things. Can't we just enjoy technology and art and be able to, trade these things and allow this technology to develop? Yeah. Anyway, let's wrap up and talk about BlockFi's $100 million SEC settlement. A 9-digit settlement with the SEC is not small potatoes here, Stephen. So what's the significance of this?
No, it's not. And some people might be a little confused from some of BlockFi's messaging that they almost seem happy about having to pay $100 million to the SEC and some of its state level companions or compatriots, I guess. And what really happened was that this began back in June. A colleague of mine, Michael Del Castillo, and I actually broke the story that BlockFi, which offers several products, but one that's known as a BlockFi interest account, which is something almost akin to a savings account at a bank, they were being sued because the New Jersey Attorney General essentially said that this type of product was tantamount to a security, and it's not really a banking product, and therefore it needs to be registered as such. BlockFi didn't agree. What ultimately ended up happening was numerous other states joined into the proceedings, and then the SEC itself got involved, and they came to the settlement where BlockFi is going to pay $100 million split evenly between the SEC and then the states themselves that issued various orders. And BlockFi is going to have to register its product. It's going to change the name to BlockFi Yield. It's going to register with the SEC. Right now, it can't take on more customers, and there's some other restrictions. But there's two really interesting things about this here. I mean, for one, what's going to happen to BlockFi's business, because making it so easy for people to get yield, which can be like 5, 8, 10%, much higher than what savings accounts today offer, was one of the reasons why BlockFi got more than $10 billion in assets under deposit. So are they going to be able to continue growing at this pace with the additional restrictions that come from being a registered company? There is no guarantee itself that this registration will be successful. Hester Peirce, who's one of the SEC commissioners, actually dissented on this agreement, basically saying that there's no guarantee it'll work, and really asked some questions about the efficacy of this entire endeavor. But then two, what happens to all the other companies that offer something similar to what BlockFi does? Nexo actually came out and said that they are going to voluntarily kind of comply with these new rules so that they stay on the right side of the law. But there's other companies like Celsius that have received similar orders, and there's certain questions about their risk management principles. And some people may also remember that Coinbase actually got into a very public spat with the SEC, although mostly it was Coinbase talking, not the SEC, when they tried to launch a similar product called Coinbase Lend, where they would offer 4% interest rate in a stable coin for letting people for letting the company borrow people's money and lend it out. And they ended up just caving and canceling the product altogether. So maybe they're going to try something different now too. So there's a lot to take on here. And then finally, just one last point. This also might inform what happens with stablecoins, because most people, when they think of a security, they think of an investment where you're hoping to make money. But there's many different ways in sort of your jurisprudence that can define or that sort of advises the regulators on what constitutes a security, and that's not the only criteria there. So I know that, for instance, Gary Gensler and some other state regulators are worried that stablecoins themselves could be securities, and this type of judgment could have an impact on that too.
Okay, but I have one more question I want to throw at you. In an alternate universe, perhaps this is a positive thing, even though a 9-digit fine is very deep in the pockets. Does it lend a little bit of legitimacy around the product that the SEC is recognizing it as a security?
Yeah, absolutely. I didn't mean to. I'm not trying to cast judgment or say that this is a bad thing.
Right.
So thank you for correcting me. It very well could be a good thing, because it kind of clears the road in some regards. It helps make things a bit more transparent. It adds a little bit of security and some assurance to these types of products, which will help make more mainstream investors comfortable and confident in investing in these types of assets. And I also think too that it was the SEC doing this. I mean, I think BlockFi has a good reputation. Their executives are seen as responsible stewards of the industry and their clients' funds. But the more they grow, it's going to bring in additional bad actors. And I think the SEC kind of want to put its flag in the sand here to sort of say these are the rules, and almost make it a warning to some of the current participants, but also future ones that may try to engage in fraudulent endeavors.
All right, Stephen, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Yeah, thanks, Jill.